Welcome back, guys, to the Editors Roundtable. The question that we are asking today, the question that I'm trying to explore today is, will the macro, the tough macro, the worsening macro global backdrop going to stop or at least give a pause to the India equity juggernaut? The way I'm going to do it is not by presenting a lot of data in terms of growth is slowing, rates are going up, because we all know the facts, but through the lens of flows and flows that come into India and into emerging markets. So, I think this says it all, from decoupling to maybe just recoupling, right? This is basically, even after Friday's fall, the equity returns for Nifty, S&P 500 and the emerging market pack in dollar terms. The Nifty, as of Friday's close, is down 8% year to date. The S&P is down 22. The MSCI Emerging Market Index is down 25%. So, the base case is, if there has to be a catch-up, they could potentially be meaningful downside. Now let's explore this, as I said, through way of flows. India has shown through and how. This data is from NSDL. This is FPI flows into India, and this is the latest data from EPFR. Just focus on the last row here. Over the last 3 months, while emerging market funds have seen outflows of $14.6 billion, India has seen inflows of $8.4 billion. This is, of course, including September so far. The numbers will change by the end of the month. Minus 14, minus 15 nearly, and plus 8.5 in India. Why is this important? This is important because we get most of our flows through emerging market funds. 94%, that is 86 plus 8, which is active and ETF. 96% of the flows which come into India, foreign flows, come through the EM fund route. And as I just showed you, EM funds are hemorrhaging money. Money is leaving them, but we are getting sort of inflows. Only 6% of the flows come through India-dedicated funds. Let me sort of break this active and the actively managed EM funds and ETF EM funds, which will better explain the point. Look at this. Actively managed EM funds have continued to lose money. This is May, June, July, August, September so far. These funds have lost almost $5.5 billion. ETFs, well, they were getting money. ETF, of course, is a smaller component as compared to active, but ETFs were getting money, if you can move on. But over the last 2 months, which is in August and September so far, this number has also started to become negative. This is as per latest EPFR data once again. Look at this, $5 billion came in May, June, July was positive, but small negative in August and September. The number is starting to grow, but on the negative side. The point is this, right? Now, this is yearly flows, both EM and emerging market active funds and emerging market ETFs. EM active funds have continued to lose money for a number of years. 2021, of course, both strategies got money. ETFs have consistently been gaining share. And the point is that this ETF route must not dry up. This is the route through which more and more people are allocating money into emerging markets. Now, to put all of this into context, right? This is a very interesting graphic, I think. India's weight in MSCI Emerging Market Index, which is one of these benchmarks that ETFs use, was 8% in 2020. Guess what it is right now as of the end of August? It is 14.5%. China's weight, which was 30% in 2020, is now, it went up to 42% in September of 2020. 2 years prior, it was 30%. It went up to 42% in 2020. And over the next 6 quarters, it fell to 30%. Similar case for Brazil. The peak weight was 31. Over the next 6 quarters, it fell to 10. Mexico, peak weight was 30%. It fell to 17. And we're at 14.5%. This, I would say, has no predictive value in terms of, the market cap goes up substantially. This weight can rise. But it does tell you that the weight has already increased quite a bit over the last 2 years, has doubled, in fact, from 7-8% to 14.5%. And, of course, there's a question mark in terms of what happens from here on. To me, I think the case is pretty simple, is pretty clear. India, while it continues perhaps outperforming emerging markets, other emerging markets, as compared to the rest of the globe, if the globe itself starts to slow down, will it start to hurt at the margin? That's the bigger point. Let's actually put that to Pankaj Tibrewal of Kotak, who's joining us right now. He's our guest on the show. Pankaj, great to have you with us here. Thank you very much. So let me just ask you that straight up. What do you think? Will the outperformance shrink? Will India catch up lower? Or do you think other markets perhaps will catch up with where India is right now? Your sense?
Hello, Prashant. I think your observation is valid. If you look at from the risk-on rally which started in June, most of the global equity markets are now back to their June lows. However, Nifty is still 15 to 70% higher than those lows. And despite of earnings cut being equal to the global equity markets, we believe that flow had a larger role to play. And when the FIs came in and the data which you showed clearly shows that India was the highlight in terms of entire emerging market. However, incrementally, we believe that the domestic financial conditions, which were benign, have started to tighten now. And the LAF surplus, which we saw for almost 3 years continuously, have turned into deficit. And don't forget that the banking liquidity has a major role to play. And if you plot the graph of banking liquidity versus market cap to GDP, there's a very significant correlation out there. So that's one thing which is turning negative. The second thing is that yield curve has flattened out, and that's not a great sign. And also the earnings yield has come almost negative more than 2% compared to the bond yields. So I think time to be a little careful and cautious. I think if globe kind of slows down, it will have some bearing on the overall Indian equity markets. We can't be so much decoupled that calendar year to date, most of the emerging markets plus your developed markets are down between 20 to 25%, and we are flattish year to date.
Got it. Pankaj, the go-to space has been financials. Do you reckon that's where perhaps there could be some steep correction because of the overcrowded nature?
Anuj, there could be some tactical correction out there because that's a large 1/3 of the weight of Nifty is there, which is in financials. But I think from a slightly medium-term perspective, I think that space will give you that strong earnings growth because the asset quality is still under control. Credit growth is picking up. There could be some pressure on NIMs as you move ahead into the rate tightening cycle. But I think the overall sector seems to be well positioned from an overall market perspective. So I don't see a very steep correction. I think investors are waiting for some kind of correction in this space to go and increase their positioning.
Hi Pankaj, Nimesh here. The other big theme you've been very bullish on is manufacturing. You've been vocal as well that that's one space which you like, and you've been betting as well. Any sense in terms of if there is a global panic, will that underperform, or do you think earnings are going to be quite strong and resilient for the next few quarters from here for manufacturing sector?
Yeah, Nimesh, I think manufacturing we have been talking about for almost last 8 to 12 months, but more and more evidence is emerging. Let me take 2 minutes on this. We traveled across the country meeting a large number of SMEs, companies in the listed and unlisted space. And the sense we are getting that the entire value chain this time is not complaining. And when Indian entrepreneurs don't complain, that means the business is doing well. And when you dig a little, 3-4 things which are adding to it. I think the corporate debt of corporate India is at an all-time low, and we are the most underlevered corporate in the entire globe right now at 46% corporate debt to GDP. And now corporates are looking back to reinvest the cash flows into their business as the capacity utilizations are rising. Second, don't forget the energy crisis which is going on in Europe. And companies after companies across various sectors are saying that the inquiry levels have moved up substantially over the last few months, whether it be on the specialty chemical, auto anks, light engineering, precision engineering, capital goods. And a large number of those companies are looking to outsource to the Indian guys. And I think if China one was talked about, in my view, Euro 1 Plus could be a bigger theme to play out for the next few years. And I think still it's not there built into the numbers of most of the street analysts. I think that's one very important theme to work out for.
Sure. Pankaj, that's interesting, Euro 1. We'll take that theme forward as well with different experts. But what are your thoughts on the consumption theme? Because we're heading into the festive season and we've seen massive demand, right? Whether it's in autos, FMCG has come back in a big way, especially in Tier 2 and Tier 3 cities. Within that entire umbrella, what are the sectors that you still like, or the pockets that you still find that there's perhaps both growth and relative valuation comfort?
So I think Sonia, autos clearly is one spot where we think that the cycle is just starting. In the last 12 months, we sold what we sold 12 years back in the passenger vehicle segment. So please wait for the pent-up demand, which will just shoot up, I think, over the next 6 to 12 months in this space. And the kind of feedback we are getting from most of the OEMs is that chip shortages is coming down and the demand seems to be extremely robust. So I think that's one space where it's looking interesting. And let me give you a very interesting data point. If you look at the profit pool of the top 500 companies in India, autos used to contribute a decade back 8% of that entire top 500 profit pool. That 8% has now come to 2.5%. And that's been the kind of last decade we lost in the auto cycle. And I think that cycle is looking much, much better. The second space is on the consumer discretionary, is the entire thing to do with the wedding play, entire thing to do with the paint segment, entire thing to do with the home improvement segment. I think that entire discretionary basket is looking good from a medium-term perspective. Staples, still we are a little careful and cautious, but don't forget that there's a data point which is suggesting us that 12 months before election and 6 months after election, normally staples does extremely well.
Sure.
So we'll keep an eye on staples as a category as well.
Okay, that was a short but power-packed interview. Thanks a lot, Pankaj, for joining in.
Thank you.
To all of our viewers from the entire editors team, thanks for watching and have a great weekend.